Hello and welcome to today's presentation. My name is Alejandro Zambrano and I work as an analyst for dailyfx.com. We're going to be continuing with the presentation that we hosted for you on April 26th at the London Masters Show. And my name is Alejandro Zambrano and I work as an analyst for dailyfx.com. You got my Twitter account here. You also got my email, which is azambrano@fxcm.com if you want to reach out to me. Okay, we're going to continue with the presentation, but before we start, I want to stress that trading financial markets is risky and that unfortunately this always risks that we lose all of our invested money. So please bear that in mind before you start trading. Okay, so we're going to talk about gold. And going to begin with this chart, which is gold but inflation adjusted. So we have gold here, the price from the 1950s, and then we have fixed this for inflation. So we have the 1950s, and here we have the latest price. Now, obviously, when we remove inflation, the chart looks less spectacular because obviously things go up higher in price just because you have money printing by central banks. And we had the latest remarkable rise of 426% from the 2001 low. At that point, in gold adjusted, inflation adjusted terms, gold was trading at $146 per ounce, and we rallied with 426 pips all the way, 426% all the way up to $769, which is not that shy or not that far away from the highs experienced in the 1970s and 1980s when we created this huge rally here. Obviously, during this period, we had a lot of inflation and people were buying commodities and gold to hedge for this. But since from the 1980s, inflation has actually been trending down lower, and during that period, the price of gold declined due to this because people will usually use this to hedge against weak currencies, in other words, against inflation. People are also going to use the price of gold or gold to hedge against political risk or war. Now, we had this decline, and then suddenly, around the year 2001, you start to see that China starting to do well. So you have demand, and suddenly more and more people have the opportunity to actually invest in buying gold. So we have this decline that lasted for about 20 years, and then we have this rally from pretty much the year 2001 all the way up to 2013. So that's a little bit more than 10 years of a rally. And if we're following these cycles, we should technically push up higher again. And I would say that the reason why we did push up higher was again fear of inflation, and then obviously a little bit of political risk, especially when stock market collapse. People will usually go from say gold as stock markets to gold, and then also pure speculation. At the end of the day, everyone just wanted to buy, everyone just wanted to go long, everyone just wanted to be part of this rally, and it seems to be fairly easy to make money on this. So that's why we had that move to the upside. So we have that decline now. And why is it? Well, number one, fear of deflation and the fact that we don't have any strong inflation anymore. We have the deflation risk. I don't know if you've been following up, but central banks like the ECB, so the Eurozone Central Bank, today, this very Thursday, May 8th, we had an ECB meeting and markets were looking for a cut, and they might cut at the next meeting, and they're talking about cutting rates. So I'm talking about making it more accessible to borrow money. Now, the reason for this is that we have a very low inflation growth in the Eurozone right now. It's actually the black line that you're looking at right now. So the latest number when I did this on the 26th for you guys was a year-over-year inflation growth of 0.5% more or less. You also have the US here, which is the red line. It's between 2% and 1%. And then you have also UK inflation, which was pushing down lower. So if you're looking to buy for a hedge against inflation, well, right now you don't have any inflation. So that's the reason why we're seeing gold pushing down lower. What else? Central bank are reducing the amount of quantitative easing. So obviously you have the ECB that might actually do more quantitative easing. They might even cut rates. However, you have the UK, so now the US-based central bank, the Federal Reserve. Now, what have they been doing? Well, they have been reducing their amount of quantitative easing over the last few months. So the seed of inflation, which is money printing, is being pulled back. They're still printing money though, but that's being pulled back. Bear in mind as well, we also have the Bank of England that is printing money. We also have the Bank of Japan that pretty much doubled their monetary base over the last year to cause inflation in Japan. But people are still focusing on the US dollar and they're focusing on what's happening in Federal Reserve. And what is also interesting is obviously that we're doing fairly good in the UK right now. And with that in mind, we might expect that we're going to see less quantitative easing in the UK as well. So the whole case of lower inflation, or that we will have inflation, that reason to buy with that reason is waning. Other argument, stock markets. Well, this is a simple ratio between the S&P and gold. So you see when we traded all the way up here and when gold peaked, for 1 ounce of gold, you could buy 1.5 times a standard contract in the S&P. We have now declined, so for 1 ounce of gold, you get pretty much 70% of a contract of the S&P. Now, the reason for showing you this is that very important to remember that when you're trading gold, people are gonna use that as a hedge. They're gonna use that as a hedge against political risk and war. So we have obviously the situation in Ukraine right now, and that could be something that could, lead to a shift. When we had the massive rally here in the 80s, every ounce of gold could buy you 5.7 times the S&P 500. So we still have a bit to go if we look at this. And what I know, and I'm not showing you here, but when we created this major low here in the year 2000, we declined to a value as low as 0.18. That was the ratio, and can't really show you here because I don't have the full chart. But in the 70s, when we created the first low, when we created this low here, we're trading pretty much at 0.35. So we're not that far away, but we can still decline a bit more. I say we can decline down to 0.5, 0.66. And at that point, we're looking at levels where if you ask me, and we say that, you want to buy the euro or you want to buy the S&P. Oh, sorry. If one would ask me, where do you want to put your money? Well, we want to put it in gold over the next 5 years, or are you going to put it in the S&P over the next 5 years? Well, when this moves down here, it's going to tell you that people rather buy gold. Why? Because if you think about it, since 2009, stock markets like the S&P have been pushing up higher. So since 2009, so we're pretty much in a mature stock market and obviously most stock markets continue for 14 years, but still 5 years. So it wouldn't surprise me a bit if we have a bit of a decline sooner or later. And then obviously you have the price of gold that is down a substantial amount, and this is what is showing. And this is something you can actually find and look and check yourself online. You're usually gonna find that there. So with this in mind, we have deflation pushing gold to trade lower. You got tapering, which is the reducing the potential inflation threat. You also have strong stock markets. With that in mind, it's not so strange that we have a downtrend in the price of gold. Now this is a FXCM chart using the FXCM trading station, and what you can see here is that we're under the 1,400 level. We got a double top, and given this, and I'm using classic standard technical analysis, we're in a downtrend creating lower and lower highs. Now, as long as trade under 1,400, this is going to be relevant. And with that in mind, if we just project and we assume that we'll continue to trade lower, then we should probably going to trade to a level where people bought before. Now, where did people buy previously? Well, they bought here, 700. At the 700 level, people bought before in late 2008. And I would say as we start to approach that level, more and more people are going to be keen on buying this. So with that in mind, I say maybe 1,000 would be a reasonable target as long as you trade under 1,400. Say that you would trade this using, say, an FXCM trading account. Then say that you would short one contract here. Then for one of the FXCM trading station contracts, you would make or lose 1 pence. So the fact that we're looking for a drop here of about $171 would eventually, also $289 would eventually generate 171 pound gain on this versus a potential risk of 65 pounds. Say that we instead look to buy 100 FXCM gold contracts, then we would be making 6 pence per pip here, and we would look to make 17,150 pounds on this, we will be risking about 6,587 pounds. So fairly decent risk reward ratios if one would be interested to trade this. And this is given the fact that we trade under 1,400, because we do have political risk right now, and that is Ukraine. Now, I don't really know what's going on in the ground in Ukraine and with Russia. And obviously, if that would escalate, and if you are of that view, then we can break the 1,400. Now, if we break that level, and it would be due to Ukraine, and you suddenly see stock markets moving down quite a bit, then yes, you have a trading case. But until we take out 1,400, I'd rather prefer to assume that deflation, tapering, strong stock markets, and a situation in Ukraine which will be contained, that's going to push us down lower and eventually we reach 1,000. What else? Well, the money is out there. This is something to think about and something that could eventually, after us reaching $1,000, could actually kick off. Now, what am I talking about? Inflation. Well, if you think about it, if we move down to $1,000 per ounce, then this, which is the ratio between gold and S&P, is going to be at a decent level. And probably at that point, when stock markets are very high, you usually get an increase in inflation. Why? Because people are usually making money. And stock markets move ahead of the real economy, which tells me that most likely if we create a high in stock markets, people are going to be really well off. Now, money doesn't just disappear in thin air. People are actually hoarding money. Money is not being used. Instead, some people, what they do is that they can borrow and trade cheaply on margin, or they can do other things with the money, but they're not putting this back into the real economy. They're not taking the money to buy a house. They're not taking the money to buy a car. They're not taking the money to invest in something useful. They are mostly investing in financial assets. Now, what is interesting is this. Now, this is the US velocity of money. And what it is a way of showing how many times the monetary base is being exchanged. You can definitely Google this. It's called the velocity of money. Now, just to make it very, very, very simple, if we assume that we have an economy where we have $100 in that economy, when it's at number 2, it just means that we're using that $100 2 times. It can be £100 as well. Very easy. Say that I have $100, so £100. Now, I want to buy new pair of shoes. So I buy a pair of shoes for $100. So I pay the shoemaker. He gets now $100. Now, obviously, to be able to produce the shoe, he probably needs to pay back, to get the leather and people helping him. So he would give some of this 100 to the supplier of the shoes, and maybe he keeps 100 for himself. Now, the shoemaker or the shoe seller, he has now 50 because of these $100, and maybe he goes and he buys something else. So, and the supplier also now has 50, and he uses that 50 to buy food for his family. So suddenly, that $100 which I started with, I used them to buy a pair of shoes, but then the shoemaker used 50 to buy for the supply, and then the supplier used 50 to buy food. So now what we did is that we used those $100 twice. And what we can see here is that from 94 all the way down to the year 2000, people were on average exchanging money 2 times, all the way up to 2.1 times. Then we had a massive drop here. This is 2007 and 2008. Why? Big recession. You have a Northern Rock in the UK. You can't get your money out from the cash machines. What do? Well, if you're not sure if you can take out your money from the cash point, well, you're not gonna start to invest or do something crazy about it. You're going to hoard the money. And what happened, especially here, because this is obviously the US, people have been hoarding, and this is all the way until the last quarter of 2013. So people are still not using the money, and they're still not using everything that has been printed by the central banks. But when unemployment rate moves down lower, and people say, you know what, I've been working for this firm now for, you know, since 2009. It was looking really bad at that point, but we're now making a little bit more money than before. I don't think things are going to turn so bad. Maybe it's time to buy a house, or maybe it's time to buy something else. Let's start to use the money that I have. That should eventually push up inflation as well. And then obviously, as inflation would increase by other reasons, again, people that are holding money, say that you have access to cheap money, or you maybe have savings in your account. Well, if inflation starts to pick up, you're not necessarily going to, we're definitely not going to like that. So with that in mind, when inflation picks up again, people are going to say, you know what, let's use my money here, because right now, money is not scarce. It's so easy to get hold of. I'm having problems with inflation, and I'd rather use my money to buy something real, like a car or like a house, because I have inflation. And with that in mind, I'd rather use my money than to keep them in the bank. So this is interesting. And with this in mind, what I want to say is that maybe when we reach 1,000, if we reach that level, it's going to be interesting to assume and maybe work with the idea that inflation will pick up. So that's an interesting idea to keep in mind as we progress, because usually and historically, when central bank have been printing money, they will usually we will usually see this in form of inflation. Thank you so much for joining in. I hope you find this useful. And if you want to reach out to me, again, feel free to just send me an email or reach out to me via Twitter. You all have my email, of course, because I sent you this email with the video. And if you want to try out an FXCM trading station account or so to try to trade gold on virtual money, feel free as well to just reach out to me. Okay, guys, talk with you soon, and I hope you have a good weekend. Thank you and goodbye.